Have you ever wondered why life insurance is pushed so hard by agents, but nobody talks about the real catches? Today, we're pulling back the curtain on the truth about life insurance nobody tells you. By the end of this video, you'll know the hidden pitfalls, smart alternatives, and how to decide if it's right for you, saving you potentially thousands in the long run. Welcome to Wealth Flow Studio, your go-to channel for straightforward money advice. In this video, we'll cover 3 key truths. First, the big differences between policy types. Second, the sneaky costs that eat into your returns. And third, when life insurance might not be necessary at all. Let's dive in. First section, the myth of one-size-fits-all policies. Life insurance comes in main types, term life and permanent life. Term is simple. Coverage for a set period, like 20 years, at a low cost. Permanent, like whole life, lasts forever, but builds cash value over time. But here's the truth nobody tells. Permanent policies often underperform as investments. Agents sell them as savings plans, but returns are typically 2 to 4% after fees, far below stock market averages. Take John, a 35-year-old in Texas. He bought a whole life policy for $300 monthly, thinking it'd grow his money. After 10 years, his cash value was only $20,000, less than if he'd invested in a simple index fund. Practical tip: if you just need protection, go for term life. Use an online calculator from sites like Policy Genius in the US or Money Supermarket in the UK to compare quotes today. Now, let's move to the next truth. Second section, the hidden fees that drain your wallet. Many policies come loaded with commissions, administrative charges, and surrender fees if you cancel early. These can eat up 50% or more of your first year premiums. The truth is, agents earn massive upfront commissions, up to 100% of your first premium on permanent policies. That's why they're pushed hard, not because they're always best for you. Consider Sarah in Ontario, Canada. She signed up for a universal life policy paying $200 monthly. Hidden fees meant her cash value grew slowly, and when she tried to withdraw, a surrender charge took $5,000. Your action step? Always read the policy illustration. Ask for a breakdown of all fees, and consider no-load policies from direct insurers like TIAA in the US or similar in the UK and Canada. Next, we'll uncover when you might skip life insurance altogether. Third section, you might not need it as much as you think. Life insurance is great for dependents, like if you have kids or a spouse relying on your income. But the industry doesn't tell you that single people or empty nesters often overbuy.
The unspoken truth: if your assets cover debts and final expenses, you could self-insure. In the US, average funeral costs are $7,000 to $12,000, easily covered by savings for many. Look at Mike, a 50-year-old in London with no kids. He paid for life insurance for decades, only to realize his pension and home equity made it redundant, wasting $50,000 in premiums. Tip for you: assess your needs with the DIME method: debt, income, mortgage, education. Calculate online via tools from NerdWallet in the US or Which in the UK, and drop coverage if it's unnecessary. That wraps our main truths, but let's explore 2 more critical angles. Fourth section, tax traps and benefits they gloss over. Life insurance payouts are often tax-free, which is a plus, but permanent policies' cash value growth is taxed if withdrawn, and loans against it can trigger taxes if the policy lapses. Nobody mentions that in Canada, some policies affect your estate taxes, or in the UK, they might push you into higher inheritance tax brackets if not in a trust. Example: Emily in California borrowed from her whole life policy for a home down payment. When she couldn't repay, it lapsed, hitting her with a $10,000 tax bill on the forgiven loan. Practical advice: if using permanent insurance, put it in a trust to avoid estate taxes. Consult a planner in your country, like via the CFP board in the US. Now on to our final point. Fifth section, better alternatives for your money. The big secret? Life insurance isn't always the best wealth builder. Low returns mean you're better off with separate term coverage plus investments like Roth IRAs in the US or ISOs in the UK. Truth exposed. Studies from Consumer Reports show term plus investing outperforms whole life 99% of the time over 20 years. Case in point, David in Vancouver bought term for $20 monthly and invested the rest in a TFSA. After 15 years, he had $150,000, triple what a permanent policy would yield. Your tip? Buy term and invest the rest. Start by opening a low-fee brokerage account at Vanguard or similar, and automate monthly contributions. There you have it, 5 eye-opening truths. Let's summarize. We uncovered that not all policies are equal. Stick to term for pure protection. Hidden fees can devour your premiums, so demand transparency. You might not need coverage if self-insured. Watch for tax surprises and consider alternatives like investing separately for better growth. For long-term success, shift your mindset. View insurance as protection, not investment. Build emergency funds and diversify assets first. This video is for educational purposes only, not financial advice. Consult a professional for your situation.
If you found this valuable, hit that like button and subscribe for more finance insights from WealthFlow Studio. Comment below, what's one insurance myth you've heard? We'd love to hear. Tomorrow, join us for Hidden Bank Fees Stealing Your Savings. Thanks for watching. See you next time.